Hello, this is Rich Vessel, founder of Advanced Projections, with our August 2023 Advanced Projections report. Here's our review of the economic data highlights for July and early August of 2023. Employment figures for July came in with another decent new jobs figure up 187,000, with unemployment moving down just a bit from 3.6% to 3.5%. We still expect to see unemployment will begin to gradually move upwards. At these low levels, we see a Fed staying fully focused on inflation, given this as ammunition for further rate increases. Employment is a lagging indicator in the business cycle, so it typically declines after a downturn has begun. We have some charts shown at the beginning of the report that show characteristic hooks in unemployment data that precede recessions. Annual consumer price inflation through July was announced on August 11th with the actual reported value of 3.2%, which was 0.2% above expectations. However, the core CPI that leaves out volatile food and energy prices was still 4.7%, and sticky price inflation less food and energy continued high in July at 5.5%, which is still more than 2.2% higher than the more generally watched headline CPI number. As oil prices have gone up again over the past month, this will add to the CPI headline inflation number in the months ahead. The Federal Reserve Open Market Committee increased their Fed funds rate on July 26th, boosting this key interest rate to 5.25% to 5.5%. We had expected them to implement another increase as inflation and employment numbers from June provided prompts to do so. They are highly likely to act again either mid-September or early November within their next two FOMC meetings. In mid-June, they issued a new set of dot plot projections for 2023 through 2025, and they've projected a longer fight against inflation with higher rates than they had previously thought. The continuing hot employment picture is likely to confirm that scenario. The Fed's June pause came with a firm indication that they plan to increase rates at least 2 more times this year unless something extraordinary happens with inflation. So we've seen the first of those 2 promised increases. Equities markets have gained over 25% since the October 22 lows were put in, pushing through resistance levels during June's Fed pause. The S&P 500 is now solidly back in bubble territory. The bond markets reveal that smart money is still paying more attention to the Fed signals and pronouncements. Our proprietary equity EKG showed extreme overconfidence, even more so than in the fall of 2021. This is usually a sign of a major market top inside a bull trap. Market behavior in early August is showing price weakness. Our indicator system keeps our recession risk level at 90% plus due to still declining leading economic indicators, continuing hawkish Federal Reserve monetary policy signals, and a deep red AP yield curve indicator. The one AP indicator showing yellow, AP precious metals, is there due to the collapsed price of rhodium. The AP stock index, which had continued to skirt the boundary between red and yellow up until mid-June, returned to full-on red by the end of June, as we expected it would in our previous reports. Now here are the current underlying economic details. Year-over-year consumer price index increases and tight labor markets continue to characterize our economy. General expectations out just ahead of this July CPI announcement were for 3.0% year-over-year inflation, and it came in a bit higher at 3.2%. The Federal Reserve completed the first of 2 rate increases promised for the second half of this year, as the underlying sticky inflation numbers are not coming down as rapidly, and employment has not yet turned to a negative trend. Consumers are still spending and accumulating record amounts of credit card debt, now exceeding $1 trillion. Bureau of Labor Statistics reports that unemployment continues to remain well below 4% over the past year, now at 3.5%, with new job gains in July of 187,000. We had expected those gains to dwindle faster in the first several months of this year, but there is still no strong evidence of it yet. We are expecting to see a more significant trend of layoffs, perhaps to begin later on in 2023. Below in the report is the BLS table showing the most recent employment situation. All employment numbers are still higher and stronger than a year ago, including the labor force participation rate and the total numbers of employed persons. This currently solid employment situation continues to keep the Fed free to be as aggressive as they deem necessary in their rate increase script, as well as in their plans for unwinding their balance sheet, thus decreasing the money supply. They have already stated so, right along with their 12 rate increases in the March of 2022 through July of 2023 timeframe, and within their last available FOMC meeting minutes. Look for continued small increases when the Fed FOMC returns with its next steps at the end of summer. Their January through July rate increases came in below our expectations, but based upon their coincidentally issued June report, we do not expect any delicacy or wavering on their part here in the rest of 2023. Expect at least one more 25-point bump yet this year, most likely mid-September, or in mid-autumn if there are no unwelcome surprises during the third quarter of this year. Also in the report below is the quarterly table issued in the Fed's June 23 report showing exactly why to expect continuing Fed hawkishness. All their projections made last March were updated again in June, showing somewhat higher interest rates and longer-lasting inflation than they previously thought. This kind of uprating has been the case every single quarter since the end of 2021. Higher rates for longer means more braking on the economy, and they indicate they expect more than a full percent higher unemployment from the current 3.5% as a long consequence for 2023 through 2025. Very tepid GDP growth was anticipated in this chart as well, but the Fed has now publicly published elsewhere that it is highly probable that the U.S. enters recession later this year or early 2024. This is despite Fed Chair Powell's proclaiming that recession is now not in their thinking. So we have to respectfully disagree with Chair Powell at this time. The Fed's previous March projections were proclaimed to be effectively unchanged from December of 22, but close examination showed the most hawkish FOMC members had increased their hawkishness. The new June dot plot showed that terminal rate expectations among the FOMC members jumped significantly in the second quarter, up a full 0.5%, which still translates into continuing expectations for higher rates this year. Federal Reserve recession probability is still reading very high, with a significant GDP decline going into 2024. We show those tables and also a chart from the Cleveland Federal Reserve that indicates what the Fed's own analysis is. Within recent months, this Fed group from the Cleveland Federal Reserve has acknowledged the high likelihood of a recession beginning later this year. This is not just a collection of opinions on their part, but a result of their own economic models using just the actions of the yield curve as the model's main input. In the energy picture, at the beginning of April, OPEC plus Russia agreed to an additional 1.2 million barrels per day in production cuts to support prices for their oil. The markets responded by moving oil up over $80 a barrel again, but that lasted at that time for only 2 weeks. And then oil collapsed by 17% to below $70, rebounding a bit back into the low 80s. Since then, that has been the basic range for West Texas Intermediate crude, $67 to $75 a barrel, up to last month when the WTI then pushed hard past $80 back to $83. We'll keep an eye on global demand forecasts to see where oil could go over the next several months, but our expected volatile range for the next several months is $70 to $85 per barrel. Gasoline prices only pushed north of $4 a gallon in a few regions this spring, as a higher than usual number of refineries entered maintenance shutdown periods, but that has been generally moderated by declining crude prices. So the probability of high gasoline prices for the summer should have been moderated, and a significant price break for gasoline had recently materialized. It did not last long, though, as oil moved through the 70s and pushed past $80. We thought we'd see an average price holding nearer to $3 than to $4 for the rest of the summer, but now it looks like mid to upper $3, barring anything major happening to refineries or pipelines. There's a lot of yin and yang in the market forces that determine natural gas prices, but for now they have generally declined significantly from high levels seen at the end of last summer. Production has overtaken demand again, and that should also relieve electric power production costs, as natural gas accounts for about 40% of the U.S. generation mix. The first 6 months of 2023 saw solar and wind power generate more electricity than coal did, as coal-fired generation declined further, with renewables and gas-fired plants making up the difference. Gas has provided 46% of America's electricity over the past 2 months, and renewable generation has also increased. Thankfully, the folks in Texas were very happy for the massive amount of renewables available to them because of the heat dome that basically sat over their state for almost a month. The Energy Information Agency has issued their own projections for declining gas and electricity prices in the near future, which are likely to take place as gas supplies continue to increase. Another mild winter ahead could send natural gas prices back down to historic lows. In equities, early February of 2022, we gave an extreme risk warning for equities as the Fed was preparing to begin their quantitative tightening program that March. Here in August of 2023, there's continuing evidence of ongoing moves to cash as reflected in the money market deposits and the long-term bond market. People are realizing the resolve of the Fed in their long-game battle against the inflation dragon. However, last month's pause by the Fed encouraged a belief by some that the Fed program was done. Above, in the written report, we showed solid evidence that they are anything but done. The recent bond trends reflect many more Treasury instrument purchases at the longer end of the yield curve, which had continued to accelerate the 3-month versus 10-year yield spread through May, ending on par with records set in 1980. This key spread now has contracted a bit since then, but if and when the Fed raises rates once more, the spread will likely open up again. Fresh news from July in the form of 187,000 new jobs, tempered with a new Fed rate bump, failed to bring new excitement to the equity indices. The S&P 500 stayed above 4,500 over the past 45 days, after recently returning to exceptionally high risk bubble territory. The last push upward was driven almost entirely by retail investors flocking to technology stocks, which we claim are outrageously overpriced. These events are likely to not temper the Fed's actions to quell inflation, however. We continue to expect a few more interest rate increases and then further general declines in equities and bonds in the intermediate term. A return from the current index level just below bubble territory to warm market levels would take the S&P down to about 3,650, and a correction to the mean would be nearer to 3,100. However, the Fed states that they are still highly resolute in their attack on inflation. That means more significant rate hikes should be expected, beginning with the next one, about 4 weeks after the release of this report. They have clearly stated what their targets are, that inflation has not fully responded as needed, and they are dead set against significantly pausing or ceasing their program too early. Further increases in interest rates should eventually translate into a decline in equity prices. Equity analysts are focusing on a return to earnings growth in the fourth quarter of this year, but if you look at the year in its entirety, earnings for 2023 will be little changed from 2022, which is no excuse for market valuations re-entering bubble territory. More than half of the earnings growth for the fourth quarter is expected to come from just 4 companies in the S&P 500: Meta, Nvidia, Alphabet, and Amazon. This is per FactSet's most recent earnings outlook report. So our recent comments about their overly optimistic projections for the year are likely to become real by the end of the fourth quarter. The major idea here is that at this point in a business cycle, one should view analysts' optimistic expectations very skeptically. Additionally, FactSet states a few weeks ago, along with their chart, which we marked in red, that the S&P 500 will be likely to report a decline in earnings for the third consecutive quarter in Q2 2023. We feel that an actual second quarter result will be -3% to -5%, but an earlier summary of analysts was saying -7%. For prices to be going up while earnings are still in decline does not say much positive for market wisdom. We monitor margin borrowing as one of our tools for indicating speculative excesses in the equities markets and for breakdowns in this metric which appear ahead of real economic downturns. The May number for this metric was up a bit by 1.9%. Some portion of equity traders are mistakenly thinking the Fed is done with its program of rate increases. This form of risk capital has clearly made some serious exits from the markets, being down 39%. An equity market bottom could be near on a historical basis when margin borrowing declines a full 50 to 55% from its previous high. So there is still the potential for a further decline of around 110 to 150 billion to realize the full decline from the last high of $1.03 trillion. Our estimate for a bottom in margin borrowing is shown in this month's markup of a chart courtesy of VettaFi's Advisor Perspectives. For our complete monthly macroeconomic report, including current recession indicators and recession probabilities, you can get free member access via the link in the description below. Be sure to like this video and subscribe to our channel for pertinent economic updates. Thank you. Feel free to leave any questions you may have in the comments below.